Anything else? Oh yeah, I still have one copy of Money Free and Unfree. Um, if you didn't get it, grab it from me at some point. Unless we ordered one extra and I was just waiting for the last book to come for no reason. Okay, so today we're going to talk about the tools of monetary policy. And no, I'm not talking about the Teague brothers in the class. We're going to go through open market operations and all that fun stuff. So basically since 1994, the Fed has been announcing a target for the federal funds rate. In the aftermath of the Great Inflation, Paul Volcker stopped targeting the federal funds rate, stopped considering that, and let it fluctuate wherever it needs to be in order to bring down inflation. But then after inflation subsided, it became much more of a focus again for the Federal Reserve. And they started explicitly targeting it in 1994 and announcing that target. And that was the federal funds rate was their main tool until the financial crisis. So basically, this chapter what we're going to do is dig a little bit deeper than just looking at the balance sheets and the money supply and the effects of open market operations. And we're going to look at the market for loanable funds, funds between banks that they loan or borrow from each other in order to meet their reserve requirements. So we're going to look at supply and demand and how those curves move based off what the Fed does. One of the questions that we're going to be answering is what happens to the quantity of reserves demanded by banks, holding everything else constant when the Fed changes the federal funds rate, whether it increases or whether it decreases. So remember for this that reserves are comprised of the required reserves, so what the Fed says banks have to keep on hand, and then excess reserves, what banks choose to keep on hand above those requirements. Excess reserves are insurance against deposit outflows. So basically, if more people than usual come and withdraw money from their bank accounts, excess reserves is a cushion against that. So that way, despite extra money flowing out that they didn't expect, they're still going to be able to meet the reserve requirements that the Fed sets for them. So the cost of holding excess reserves is the interest rate that they could have earned minus the interest rate paid on the excess reserves. Very, very simple idea that what they could have gotten versus what they end up getting. So since 2008, the Fed has paid interest rates on reserves. And they set it at a fixed amount below the federal funds rate target. So they choose, I'm not sure what it is, say 50 basis points below what they want the federal funds rate to be. When the federal funds rate is above the rate paid on excess reserves, when the federal funds rate decreases, the opportunity cost of holding excess reserves falls, and the quantity of reserves demanded rises. Basically, what this implies is that there's a downward sloping demand curve, and then it becomes flat once you reach the interest rate on excess reserves. Once you reach that level of interest rate on excess reserves, the federal funds rate can't go any lower because banks could just earn excess reserves. So they would just hold a ton of those and never have to borrow in the federal funds market. As we've seen banks not borrow in the federal funds market because they're holding excess reserves. They're holding a lot of them because of the interest rate being paid on them. All right, and then supply in the market for reserves. So there's two components. Remember, there's non-borrowed reserves and borrowed reserves. So non-borrowed reserves. I wrote this down somewhere so I didn't get it backwards. Non-borrowed reserves. Yeah, non-borrowed reserves they mean non-borrowed from the Federal Reserve. So this is what they borrow from other banks. That's the lending that takes place in the federal funds market. Borrowed reserves, on the other hand, are borrowed reserves from the Federal Reserve. So this is the loans from the discount window. Borrowed reserves make up a very, very small part, if any, of the reserves for the past several decades. Banks tend to borrow from each other rather than the Federal Reserve because of the signal that borrowing from the Fed sends, that they can't get it from other banks. So it seems like they're unhealthy, even if they are solvent. The cost of borrowing from the Fed is called the discount rate. And then borrowing from the Fed is a substitute for borrowing from other banks. So in this case, they either borrow from the Federal Reserve or they borrow from other financial institutions. So if the federal funds rate is less than the discount rate, then banks will not borrow from the Federal Reserve, and the borrowed reserves are going to be zero. Again, because it'll be cheaper to pay back other banks at the federal funds interest rate than it would be to pay back the Fed at the discount interest rate. That's regardless of the signal that it sends of borrowing from the discount window. The supply curve is going to be vertical for pretty much the entire way until the interest rate on discount lending. At that point, in our model, it's going to be horizontal, so perfectly elastic. Because at that point, you can just, you can use the discount window instead of going to other banks because it'll be the same price or cheaper. Yeah, if it goes above the interest rate on discount loans, banks could borrow from the Fed at a lower rate and turn around and relend at the federal funds rate. By doing that, they can push down the interest rate and the federal funds rate back down to the interest rate on discount lending. So that's basically, just the market in action. So this figure shows the equilibrium market for reserves. Basically what we just talked about, but putting a visual to it so it actually makes sense. So basically how the federal funds rate works is it moves within a corridor. Can someone tell me what, well, no, let's move past that. So the Fed sets their target for the federal funds rate. In this case, it's the red here, interest rate. The federal funds rate star. That's their goal in this example for where they want the federal funds rate to be. What they do is they adjust their policy, so they adjust the open market operations, either buying securities from banks or selling securities to banks, so that banks will lend to each other at or very close to the target rate. So in this way, remember, they're not actually setting the federal funds rate. What they're doing is using their policy to influence the federal funds rate and move it in the direction that they want it to go. We typically use shorthand, which is pretty much just laziness, saying that the Fed sets the rates or they move the rates. But what it really is engaging in policy to influence the federal funds rate, which is important to remember. Because they set the discount rate, they set the interest rate on excess reserves. So they set the top and the bottom of the corridor. In reality, this may not work perfectly. They may not always hit their preferred target for the federal funds rate, and it can move within the corridor between the discount lending rate and the interest rate on excess reserves. Can you guys imagine a situation where the federal funds rate increased to slightly above the discount window rate, and a rational profit maximizing bank would still go to the federal funds market instead of going to the discount window to lend?
Kind of like what you were just talking about with they don't want to make it seem like they're going to the discount window, so it looks like they're still sold in.
Yeah, so they may say the bank isn't very healthy. They may be insolvent, or they may be close to being insolvent. They may still find it beneficial to borrow in the federal funds market. They pay a little bit of a premium, but they're still not signaling that they're unhealthy. Um, I don't think that's very common, but just something to remember that sometimes it is. You have to take an expanded view when you try to look at or try to anticipate what an individual or firm's action is going to be. Even though they may be spending a little bit of extra money, they're still benefiting by signaling that they're healthy. So banks want to hold the optimal amount of reserves. So that's going to be enough to meet the reserve requirements, and to be able to honor checks that that their depositors write to other banks, but not to keep excess reserves when they can make a lot of profit elsewhere. So when the interest rate on excess reserves are low, or when the amount of the interest rate they can earn in other assets is a lot higher, they're going to keep very few excess reserves. They're going to try to minimize those as much as possible in order to earn profit where they can. In times when the interest rates they can earn on other assets is extremely low, they're going to hold a lot of excess reserves. So we saw in the aftermath of the financial crisis, interest rates were super low throughout the economy. So banks weren't giving up that much interest in order to keep them in excess reserves. It might have been slightly worse for their profit, but the risk was very minimal. Whereas the risk in most of the other assets, even the relatively safe ones, were still considerably more risky than excess reserves. So consumer spending is random. It's difficult for banks to assess when people are going to buy stuff because there's so many people involved that can make different choices that definitely seem random from the outside. Well, banks are typically used to this and do a pretty good job of accounting for random patterns in spending. Sometimes they're left with too much or too little money at the end of the day. So in that case, they can borrow or lend those funds in the federal funds market, depending on what they need. So if they have more reserves than they anticipate at the end of the day, because none of their depositors spend any money that day, they have a lot of excess reserves, they can loan those out overnight and earn interest on it. And it's a pretty safe way to lend. On the other hand, if they don't have enough, they can borrow from a bank who does have those extra reserves and pay a small penalty, but it's still not too bad, in order to meet their reserve requirement. So like any market, we can analyze this using supply and demand. So our equilibrium in this market is going to be where the supply of reserves, so this RS on this interesting curve right there, meets the demand for reserves, this other oddly shaped curve. Unlike a typical market where we use just two straight lines at 45-degree angles to each other, in this case, like we said, the supply of reserves is going to be vertical for most of it, and then horizontal once we hit the rate on discount loans. So that's why we get these different shapes than normal. So basically, when we analyze this market, it's going to be just like any other market we look at. Anything, it's going to be the same processes that Adam Smith talked about with the invisible hand doing all the work. So in the case of the interest rate for the federal funds rate is up here at IFF2. That means that there's an excess supply of reserves in the system, in the banking system. If that's the situation, those excess reserves are going to bid down prices, or bid down the interest rate down to the equilibrium federal funds rate. Banks are going to have to offer a lower interest rate in order to attract borrowers, and that's how it's going to compete down the equilibrium. Because at this interest rate, there's going to be more reserve supply than demanded. So there's going, like musical chairs, someone's going to be left over with extra reserves. So if they offer a slightly lower price, they can still earn a profit and guarantee to make that loan. So they're going to earn something. And that pressure, people doing that, banks doing that consistently, is going to move along the demand curve right back down here to the equilibrium rate. And just in the opposite way, if the interest rate is too low, if it's below federal funds target, oh, sorry, I messed up the first time. There's excess supply here, and because here there's the excess demand. Difference between the supply curve and the demand curve. So here there's going to be excess demand for reserves, so they're going to hold extra reserves. But, and it's just in the opposite process. This time they're going to compete the interest rate up to the federal funds rate target, to that equilibrium level. The federal funds rate falls to the interest rate on excess reserves. Banks will hold excess reserves, so the federal funds rate can't fall below that. Okay, so the effects of open market operation depends on whether the supply curve initially intersects the demand curve in its downward slope section versus its flat section. So whether it's intersecting here where it's downward sloping, you'll see a different effect than if the supply curve is over here in the flat section. So an open market operation purchase can cause the federal funds rate to fall, whereas an open market sale causes the federal funds rate to rise if the purchase is being made in the downward sloping section. So as long as you're not on the flat part of the RD curve, the purchases will change the federal funds rate. When the intersection of the supply reserves and the demand for reserves is at the flat section of the demand curve, there's going to be no effect on the federal funds rate. And if the intersection of supply and demand occurs on the vertical section of the supply curve, a change in the discount rate will have no effect on the federal funds rate. Okay, we're going to walk through all of these with graphs, so this is just like a preview to try to understand what's going on. If the intersection of the supply and demand curve occurs on the horizontal section of the supply curve, so up the flat section up top, a change in the discount rate shifts that portion of the supply curve, and the federal funds rate can either rise or fall depending on the change in the discount rate. And finally, when the Fed raises the reserve requirements, the federal funds rate rises, and when the Fed decreases reserve requirements, the federal funds rate falls. The Fed hasn't really changed reserve requirements in a long time. It's just kind of a throwback to an earlier era, but it's still one of their possible tools. They still can do it. So now we're going to explore these graphically. So right here we have an open market purchase in the sloping part of the demand curve for reserves. So if the Fed makes a purchase, it's going to cause the federal funds rate to fall. And it's simple, you're shifting the curve from here to here. So the number of non-borrowed reserves is going to increase in the market because the Fed is making an open market purchase. Remember, when they make an open market purchase, they're buying assets, so they're giving money to the banks, increasing their banking reserves. And downward pressure on the federal funds rate because of that. However, if the federal funds rate is down here on the interest rate on excess reserves, you're not going to see a change in the federal funds rate. Remember, because it can't go below the interest rate on excess reserves. You're still going to see an increase in the number of reserves. You're just not going to see a change in the interest rate. I really wish these PowerPoints had a clicker so I could just stand over there and not walk back and forth. So this shows the response to a change in the discount rate. So if the Fed lowers the discount rate, that's going to shift this horizontal section down on the supply curve. Does not affect the federal funds rate at all, but what it does do is shrink the corridor. So now instead of the federal funds rate being able to move between IOR and ID1 up here, like it did before, now it can only move up to this ID2, the second one. So when it's crossing the downward sloping part of the reserve demand curve, that's not going to do anything to the federal funds rate itself. Now here where the horizontal portion of the supply curve crosses the downward sloping part of the reserve demand curve, that means the federal funds rate is at the discount lending rate. So if the Federal Reserve lowers the discount rate, it's also going to lower the federal funds rate. Because in this case, the federal funds rate is at the peak that it can be, it's as high as it can go. So when they push down the discount rate, that's going to push down the federal funds rate as well. So now it will still fluctuate between the discount rate and the excess reserve rate. It move within that band. But because it's at the top now, it can't stay high. And in this case, this will increase the borrowing reserves. So the non-borrowing reserves that they're getting from banks aren't going to change, but the borrowing reserves from the Fed at the discount window are going to increase in this move. I should note that this situation right here is very rare. That's not your typical policy situation. This is 99 times out of 100, that's what's going to be going on. You guys have any questions about the first two, the discount rate or the open market operations, and how that affects supply and demand? Like I said, class, I guess it was Monday, we're using the general neoclassical approach of just looking at what happens to supply and demand curves as they move. We're not trying to understand the decision making going on for banks. It doesn't really help us understand what's going on here. Even though I say in economics, some of the best stuff is trying to understand what choices individuals and firms are making, trying to understand the incentives they face to see how that impacts what they actually do. In this case, we're abstracting away from most of that to understand just how monetary policy affects, in this case, the market for loanable funds, but later on, we'll see how it affects the broader economy. And we just want these kind of broad strokes to understand the general effects. So now for a change in required reserves, if the Fed increases the reserve requirements, that's going to shift the sloping part of the demand curve to the right. What that's going to do is end up increasing the federal funds rate. Because they're increasing the reserve requirements, banks are forced to keep more reserves on hand. You're going to have they're less likely to have excess reserves on hand. So that's going to bid up the interest rate on banks lending to each other. So that's why you see the interest rate increase here. Again, this is not a tool the Fed commonly uses. Originally, this was the first tool of monetary policy that the Fed used. This is about it. Then they moved to discount lending, then to open market purchases for to influence the federal funds rate. Yeah, I think I mentioned earlier, they don't change this very often. All right, now, finally, we're going to look at the response to a change in interest rate on reserves. So the Federal Reserve, in your typical market, where the supply crosses that the downward sloping portion, if the Fed increases increases the interest rate on excess reserves, that's going to move the horizontal portion of the demand curve up. Typically, it's not going to affect the federal funds rate, again, because there's a cushion between the federal funds rate and the interest rate on excess reserves. It's going to decrease the corridor within which the federal funds rate can move. So you're not going to see a change in non-borrowed reserves, interest rates, any of that. However, if the federal funds rate is at the interest rate on excess reserves, so again, if the supply curve crosses the horizontal portion of the demand curve for reserves, in that case, the federal funds rate, because it can't be below that, is going to get pushed up with the interest rate on excess reserves. So it's going to move with the demand curve up to there. Does this make like intuitive sense to you guys, especially the second part where the federal funds rate is at either the discount rate or at the excess reserve rate?
So the interest rate in the flat section, that's the interest rate on overnight loans?
For supply or demand?
Demand.
For demand, no, that's for the excess reserves. So those are the extra, above the reserve requirements that the banks are keeping on hand. The supply curve, that's for discount lending. So that's usually overnight. That's just when banks can't get it from another bank, they go and they get it from the Federal Reserve.
Okay.
But that's just to meet the reserve requirements. Usually, once that night's over, they pay it back immediately the next morning, and then they operate as normal. But if everyone else is shifting, like supply and demand curves make sense.
So the horizontal part of the demand curve moves up in both of those, is what you're saying? Right?
Yeah.
Okay.
Yeah, so in this case, that because the horizontal part is the interest on excess reserves. That's how we got. Any of you guys watch Peaky Blinders? I love that show. The 5th season just came out over in Britain. I don't think they put it on Netflix eventually, but so my roommate and I just pirated it, while it was on. I don't know if you guys had any thoughts. Apparently, the season finale was kind of controversial, I guess. Like some people didn't like it.
Anything about the New York movie?
We don't have cable at our house, so we would just pirate everything. But we were watching something last night, and it had commercials in it for some reason. So I finally got to see the Joker TV spot where he's just going down the stairs. I heard some really good things about it.
I heard it's really controversial.
Really? What's controversial about it?
That guy came in and talked about the guy who owns the rights to Batman.
Yeah.
He was talking about it. He said it's super controversial. But he also said he got an 8-minute standing ovation at the film festival he went to.
Damn.
Wow.
Yeah. So,
Came out last night.
yeah.
Oh, it's out already?
Yeah, he said it's going to be talked
I don't know, part of the plot was controversial, or some people like what happened and some people don't like what happened.
I think it's the plot, because he was saying politics and stuff are going to come into.
Oh, okay.
They think a sympathetic murder is going to inspire more people to do mass shootings and stuff.
Oh, okay.
Because they humanize the Joker and make it
Yeah. Well, don't you have to if it's about him?
Yeah, they did
Right.
that.
Yeah, they did not humanize him at all. They didn't give him what he was a terrorist.
Yeah.
Huh, that's an interesting. Yeah. pirate it and watch it.
It's Always Sunny this week. They ended up being a like a focus group for a movie, and they were complaining that they like the first 3 in the series were like rated R and they were like really dirty, and this one was like PG-13, and they were complaining about like people in Hollywood like not wanting like dirty movies and stuff. And then she just said, yeah, the reason it's not R is because no one goes to R-rated movies anymore. They just pirate it. And then they did like a funny like anti-piracy thing, which was ironic because I was pirating when I was watching it. The characters trying to argue, they're like, no, we don't like pirate. We watch at home, but it's not like pirated. And she's like, well, what website do you go to? And he's like, oh, stealfreemovies.r.
Not hard.
And there was like 4 other ones like pirate like words like somewhere in it. And then it's like, all right, I'm starting to see a theme here. But I don't feel bad because we had to watch the commercials in it, so we basically didn't even pirate it.
That's true. I mean, you still did. You get to watch commercials.
But yeah, I still saw the commercials, and
Yeah.
the advertisers paid for it. I'm just trying to make myself feel better, okay? I called out like halfway through the episode.
Who do they think they are putting their commercials and good content?
Yeah, you understand how annoying that is to me? I could get out a cool 22, but instead I had to go like all 30 minutes because it's filling up with commercials. Forget what's going on. All right. So let's do a little application. Think of what happened in real life with this. So it's how the Fed's operating procedures limit fluctuations in the federal funds rate. So supply and demand analysis for the market of reserves illustrates for us how one of the advantages of the Fed's, it says current, but really it's the former procedure for operating the discount window and then the paying interest on excess reserves limits the fluctuations in the federal funds rate. The basic idea is that federal funds rate can't go below the interest on excess reserves or above the discount rate. And in that way, they keep it fluctuating in between there. So in this case, say, I don't know, something random happens in the banking system that day, and there's an increase in the demand for reserves. You can have a substantial shift over here, up in, which in theory would, if let's say the supply curve was just purely vertical, it would be up here from this shift right here. It would probably cross about there, which would imply an interest rate right about here. Because of the discount rate that operates as like the ceiling on the federal funds rate, it's going to be stopped right here at the discount rate. So where it goes horizontal, it's going to cross the curve there. And it would be a lower interest rate than if there was no discount lending. Likewise, if there's a drop in the demand, a decrease in the demand for reserves, and it moves back to here. If there was no interest rate on reserves and the curve kept going down, the interest rate we would get would be down here, which is below interest rate pay and excess reserves. So basically what we see is greater fluctuations in the federal funds rate because both of these act as a backstop, keeping it within that target. Typically, on a normal day to day, even from week to week, we don't see the Fed hit the federal funds rate target. They list the target. Usually they list a 25 basis point window at which they want to target the federal funds rate. So right now it's at 1.75% to 2%. Because they know there's going to be fluctuation around here based off of the supply and demand, mostly demand for reserves fluctuating day to day. But the goal is to keep it within as narrow a window as possible so that banks can expect it to be at that rate. Again, this is because the Fed doesn't set the federal funds rate. They just set the target and they try to influence the banks using their tools so that the supply and demand crosses at that point. Obviously, the market's going to move based off of the wants and needs of all the banks in the banking system, which the Fed can't control, they can't anticipate. They don't have the knowledge to understand what's going on the ground in like every single bank branch in the United States. But they can get the basic broad idea of what's going on.
I bet they can figure it out.
They don't, well, S&T's not
Tapping
open
all the
anymore.
cameras.
They don't know how many people are running up to the ATM that First National has on campus and pulling out money. Too many people do. The nearest First National branch, I don't know where it's at, I guess say Evansburg, has to run some cash over and restock the machine. Fed doesn't know that some fraternity's having a party with a $5 buy-in, like at the door. And that's why people are withdrawing cash here. Something they can't anticipate. There's just so much knowledge dispersed throughout the system that they can't. So it fluctuates, but it's pretty narrow. The Fed does a pretty good job of keeping the federal funds rate near this target. I feel like there's something else I wanted to say there, but I got distracted. Going off on another tangent. All right, so during normal times, the Fed uses 3 tools of monetary policy. Open market operations, which is the main one. Discount lending, which is mostly used in emergencies anymore. And reserve requirements, which don't really change, but provide stability for the financial system. And they do these to control the money supply and through the money supply interest rates. So, especially now, we call them conventional monetary policy tools because of the changes we've seen since the financial crisis. So, they changed the way they use the interest rate on excess reserves. They began using forward guidance, which wasn't a tool they used previously, although now, recently, they've begun backing away from forward guidance. What else did they use? I'll just say quantitative easing is different from typical open market operations. Instead of just buying the short-term government assets, they were buying longer-term government assets. They were buying agency mortgage-backed securities, so Freddie Mae and Fannie Mac. They wrote or guaranteed a lot of mortgages in the lead up to the financial crisis. Federal Reserve bought a lot of the assets they created that are backed by residential mortgages. So they would, put together, say, 100 mortgages from people paying off their homes and sell it as a security. People buy that, pay a big fee up front, and then receive money, every month when people pay off their mortgages. And obviously they would sell it for a lower price than the money they would get from it eventually. Net present value and how they figure out financial stuff. So there's 2 types of open market operations. There's dynamic open market operations and defensive open market operations. Dynamic open market operations is when the Federal Reserve is trying to adjust the federal funds rate. So last meeting they announced they wanted to lower the federal funds rate. They lowered their target. So they made open market purchases to lower it by 25 basis points. That's your dynamic open market operation. Your defensive open market operation is when the federal funds rate begins to move because of things going on in the banking system that the Fed doesn't have control over. One of the major causes is float, which is short-term increase or decrease in reserves due to the Fed's, just increase in reserves due to the Fed's check clearing process. So we talked about that with the money supply a little bit. I didn't really mention it then. Before the check clears, when it's written on one bank to another bank, technically both banks have that check in their reserves for a short amount of time. So that's going, obviously once the check clears, the Fed takes it off the first bank's, off their balance sheet. But for a brief period of time, both temporarily have it. So that changes, the amount of reserves in the system. Sometimes they conduct defensive open market operations to do that. I don't know why they picked wrote it in this order, because what they used to do that is what's called repurchase agreements or repos. So they will sell an asset to the bank for, they give them an asset, they take their money. And they agree to sell it back to them, to reverse the trade after a short period of time, usually between 1 and 15 days. Again, this is done just to adjust the federal funds rate in the short term in order to keep it at or near their target. There's also, the textbook calls it match sale purchase agreements, but they're more typically called reverse repos, or reverse repurchase agreements, where just the opposite happens. The Fed buys a bond or buys an asset from a bank. So it gives them money, increases their reserves, and then within 1 to 15 days, they reverse the transaction. Repos are much more common, but the Fed also engages in reverse repos. I think it was about a week ago, the Fed rolled out, they conducted a new round of repos, and there was a problem with the system. There ended up being too many reserves, and the federal funds rate and the number of reserves spiked real quick before dropping back down. And a lot of people were freaked out about that. It turns out it's just growing pains of the Federal Reserve. This is the first time they've done it since they expanded their balance sheet. So now the effect repo has is much, it's different, usually much greater than it was before. And one of the reasons why the Fed wants to keep their portfolio so large, they increased it from 1 trillion to 4 trillion during the crisis, and now I think it's back down to 3 trillion. They need to keep it a certain size so that they can engage in enough repurchase agreements. Other thing to mention is the primary dealers. The way I mentioned that before, the primary dealer system where the Federal Reserve only conducts open market operations with certain, they call them counterparties, with certain financial institutions that they've chosen. So only they can go and either buy bonds from the Fed or sell bonds to the Fed. And from there, those primary dealers loan or borrow funds from other banks. And that's how open market operations spreads throughout the financial system. So it doesn't increase or decrease rates immediately. With computers and everything, it's not people running, couriers running back and forth. So it goes really quick going from bank to bank. But it's not, they don't trade with all the banks out there. It's just a couple. I think we're running up on the end of class. Yeah, we got 5 minutes left. So